Hello and welcome to the Reorg, where we dive into the Satoshi Nakamoto Institute archives and re-examine old ideas after years of accumulated proof of work. This is your host, Michael Goldstein, also known as Bitstein, and joining me as always is my co-host, Pierre Rochard. Pierre, how are you doing?
I'm doing very well. Excited to be recording a podcast on today's date.
Yes, you've been recording lots of podcasts. You took our comments on a previous episode about the importance of more podcasts very seriously. And it's wonderful to see, although I don't think I'll be able to listen to them all. So
yeah,
that's unfortunate. You just have to live in the moment as you record them.
That's right.
So today we are continuing our journey through the S&I mempool crash course, and we have gone through the articles on altcoins, and we're getting to what I think is one of the most important articles on the website. It's another very short one, but it's just one of these arguments that has been incredibly persistent for all the years, and it's kind of an understandable one given where people are usually coming from with their monetary theories. But I think as we discuss, we'll see that it really is not an issue for Bitcoin at all, and quite the opposite. And I'm of course speaking of the critique of volatility. So Daniel Krawisz wrote an article on volatility in January 2014 called I Love Bitcoin's Volatility. And I wanted to start by just taking a look at the chart. I'm going to have to explain this for people who are just listening, but just to get a sense of what we were dealing with. In 2011, there had been a bubble going up to $30 and then back down, I believe, under $1. And then going towards the end of 2012, starting around $10, there is a big run-up culminating in early April 2013 of $230 or so. And then it crashed. There's that great video of Bitcoin always crashing. And it went down to $80 and kind of bumped up, and looks like the lowest after that was around $66. But not too long after that, so the end of 2013, Bitcoin skyrocketed to over $1,000. It went down a bit and then back up, and then it crashed, and then it came back up, and then crashed really hard down into the kind of 550 range or so, and then it went back up to $900. And then that's about when we get to this article, where the price was around $790 at about January 28th, 2014. So Bitcoin was doing a lot of interesting whiplashing. There was certainly a ton of volatility. But of course, for anyone who is paying attention from say 2012, there was nothing but exuberance. But from the outside, for those who don't really care for Bitcoin or didn't understand it, this seemed rather insane. And of course, as we've discussed previously, there's the general bubble talk. But this volatility is seen as such a detriment to Bitcoin as well. And Daniel wrote an article that I think I would guess at the time it helped a lot of people kind of work through this, and I think it's an important article for that reason. So that's what we're going to read today. So I love Bitcoin's volatility. Last thing before we start, is there any other historical context you wanted to add?
No, I think you covered it. I mean, I think everybody wishes they had a time machine to go back to those prices.
There's no one in Bitcoin, I would argue, that doesn't have some kind of regret story. And it's all about, developing humility and gratitude.
Exactly right.
So starting off, I hate success and happiness. The discourse surrounding Bitcoin is often characterized by boot-quaking naysayers crying about things that don't make any sense. Bitcoin is too volatile, they lament. Nobody will ever use something so volatile. Bitcoin will never be widely adopted while it's like this. This argument is superficial and short-sighted. Volatility is not a property that is inherent in Bitcoin. It is caused by the way people currently treat Bitcoin in the market. It is a function of people's attitudes and behaviors. Bitcoin's rapid adoption rate almost completely explains its volatility today. I see no need, at any rate, that any additional explanation is required. Bitcoin's enormous manias and crashes are simply a reflection of the difficulty of negotiating a reasonable price, even in the short term, in an environment that changes so quickly. Something that regularly grows in both popularity and usefulness will necessarily be volatile. To complain that no one will use Bitcoin because it is too volatile is therefore like saying Bitcoin's adoption rate is so astonishingly fast that it will never be popular. It's like saying this oven is heating up so fast that I'll never be able to cook with it. It's like saying this novel is so exciting that no one will ever read it. There is no evidence that Bitcoin's volatility is hurting it. Any imaginable indication of Bitcoin's adoption rate will show that its adoption rate is extraordinarily rapid. So how exactly can volatility be a problem? If Bitcoin were less volatile, would it have an even more rapid adoption rate? This is nonsense because Bitcoin's price has to go up as more people start using it. And if a lot of new people start using it, then it has to go up fast, that is, be volatile. What a thing to complain about. There's no pleasing some people. These people are on to something so fantastically great that people go mad trying to get some whenever they learn about it, and they are wringing their hands and shedding tears. It's hard to imagine a more severe Jonah complex. Obviously, the people buying Bitcoins don't consider it enough of a problem to deter them. And the Jonah complex is basically this psychological concept of people being afraid of their own success. And yeah, I think what's his name? Yogi Berra, has a lot of phrases like this. There's like, what's the one with the restaurant?
Yeah, it's too crowded. Nobody goes there anymore.
Yeah. So it is interesting that volatility really is one of those things where people look at it and they mistake something that is indicative of something coming to life and growing as this giant negative because they have their fixation on what they think the ideal end game for money is. But Bitcoin's brand new, and it takes time to develop into these things. And that's assuming that their end game is even a correct vision of how money operates.
They also use volatility as shorthand for the price going down. When really, from a financial perspective, volatility is both up and down. And if you look obviously at Bitcoin's history, it's mostly upside volatility.
Yes, I mean, we see the downside volatility is hardly even visible once you've zoomed out. This is the importance of zooming out. Yes, in fact, right now on the screen we're looking in linear, and there we go.
It's very stable.
Well, yes, it just has this very stable curve going up and to the right. And so, yes, I think that's right, that volatility is always viewed in the negative side, but not in the positive side. And when those balance out, and not just balance out, but the upside is so much greater that it seems so silly to fixate on.
When people are like, hey, why did Bitcoin crash? It went up too quickly.
Yeah, it went up, like 20x. It's possible that there might be a little bit of a correction as people realize that maybe they got a little exuberant about what would happen in the short term.
Yeah.
So continuing on, volatility versus liquidity. Volatility can be distinguished from liquidity, which is something that Bitcoin really does need. Liquidity means that a valuable amount of the good can be bought or sold without significantly altering the price, whereas volatility refers to the degree and rapidity of price changes, independent of the volume of trade. The liquidity of a currency limits the size and volume of purchases that can be made with it. If you could not buy or sell the same value in Bitcoins as a house without significantly altering its price, then you could not purchase a house with Bitcoins. A currency can be volatile and still be liquid. If it is liquid, if one person can buy a lot without affecting the price. However, if lots of people all try to buy a lot at the same time, then it will still be volatile. And we've talked quite a bit about the importance of liquidity. I don't know if you have any more on this specific section.
No, not yet.
So the right price. This brings up the question of what a good price for Bitcoin would be. When will Bitcoin stabilize? It should become less volatile as it becomes more widely adopted because it will be harder for local events and individual people to affect the price very much, right? Not necessarily. Although perhaps we will see less wild daily swings, I think Bitcoin is unlikely to ever attain anything like a stable price. If Bitcoin's price were stable, this would mean that it had achieved an equilibrium with the other currencies. There would have to be some sweet spot at which there is exactly the right balance of Bitcoins and dollars. When Bitcoin's price went a little bit too high, people would start to sell for dollars, and when it went a little bit too low, people would buy more Bitcoins. To anyone who thinks this is possible, I ask, why would any equilibrium happen? What would it possibly mean for Bitcoin's price to be too high? Unlike just about anything else, a higher price for Bitcoin does not reduce its usefulness one bit. One simply trades in smaller amounts of it. In fact, a higher price makes Bitcoin more useful because a higher price indicates that more people want to buy, which means that Bitcoin's liquidity grows, which makes it more useful as a currency. Therefore, I would suggest that we should never expect an equilibrium between Bitcoins and dollars or any other currencies. Instead, Bitcoin should show a pattern of hyper-monetization. This was written before hyper-Bitcoinization. It will become more and more valuable at a faster and faster rate priced in terms of other currencies. Its price chart should show an asymptotic increase that approaches infinity after a finite time. Bitcoin may stabilize in terms of real goods, but I see no reason to think that it will stabilize in terms of other currencies. Once Bitcoin starts killing the other currencies, it will still be volatile, and this will still be an indication of its success. If my prediction is wrong and Bitcoin ever stops being volatile, that might be a good time to dump it. So, first of all, I agree with, and I think it's a good point to make, that there's basically no reasonable equilibrium between monies, and this is why we've talked previously about the world preferring a single currency. That means that when you have these winner take all, we mean it, and so there's not going to be a reason that you're just going to stop halfway and kind of just like freeze there relative to the others. If a currency is literally better and it continues to grow, well, then you expect it to continue to grow. And so as far as other currencies, I completely agree. There's no stabilization process. As far as real goods, I do think that Bitcoin would likely be more stable than it is today. But at the same time, the economy is dynamic, and new technologies come out that increase production or change people's preferences. Unexpected cataclysmic events could occur that alter the economy in some way for a period of time. And so I think an important thing with this comes from, there's a great section in Human Action by Mises about economic calculation. And there's a section called The Root of the Stabilization Idea. I have it here up on the screen. And, he points out that economic calculation does not require monetary stability in the sense in which the term is used by the champions of the stabilization movement. So this is very much looking at, kind of basically mainstream economists who believe that one of the important, one of the important roles of the central banks and such is to make sure that money has a stable value so that people can go about their business. And what Mises basically argues is that money does need to be able to float, because people need to be able to decide if they need more or less. And he says that really what you need is not worrying about the stability of price. The market will figure out what money serves them best based on their needs. Instead, he focuses on the need to keep government interference out of the money, so that you basically keep the people who think that you need an obsession with stabilization from being able to actually impose their worldview onto others, and actually end up ruining people's ability to do economic calculation. And the reason why that's the case is effectively that these people are effectively trying to create a world that can't exist. They want to imagine that you can have a world that does not have uncertainty. But the whole reason we have money, as we've talked about before, is because we have uncertainty. And so, uncertainty is inherent to action. And when you're trying to focus on the stabilization of the price as opposed to the stabilization of the properties of the currency, so to speak, like the real properties, you're interfering with people's ability to make the economic decisions they need to make.
The other thing is that, if you really need to lock in the price of a commodity, let's say as an entrepreneur with an input, that's what futures markets are for. And so you can find others who are willing to sell something to you today that will deliver it in the future, and to lock in that stability of price for your economic calculation to make sure that you're operating at a profit. And so that's the other piece where, like, the market has mechanisms for stability that don't involve a currency debasement.
Right. And it's, as we accumulate capital and we have lower time preference and we're able to think further into the future, we're able to, kind of make our own, not central planning, but our own economic plans based on long-term views of the future, then we naturally develop the tools we need to overcome more of the uncertainties that we might face in the future. This comes obviously in the form of money itself, because having a cash balance allows you to kind of deal with all sorts of uncertainties as a whole. And then there's also in the form, in capital of, developing better engineering that means that your goods and services are able to withstand more types of, say like natural disasters, like you have buildings that are better equipped to deal with earthquakes, or bridges being able to deal with high winds, and so on and so forth. And so, yeah, the market as a whole is able to do that process. You don't have to ruin the money to get it. If you're worried, like stable things, like having stability is a good thing, but you can't force stability. And there's no like true stability. It's something that you are trying to get to. And the people who focus so much on the price here, they live in a fantasy land where none of these uncertainties exist. And like you're saying, they imagine that we can't, develop other ways of dealing with it. And finally, they are also looking at Bitcoin from a very short-term point of view, in the sense of they act as though where Bitcoin is today is the end game. And so when Bitcoin is not, stable enough to where they think they can handle whatever kind of economic thing they want to do with it, they see that as a failure of Bitcoin, as opposed to, letting Bitcoin continue to develop and seeing if it's able to handle more of the economic issues that they personally face. And the rest of the economy, like he says earlier in the article, obviously the people buying Bitcoins don't consider it enough of a problem to deter them. It's like, empirically, it clearly does not matter to people that it's volatile. And, the best that, someone like that is going to be able to come up with is probably something along the lines of, it's just a bubble, which just, as we've talked about before, just shows, it sort of betrays them and reveals that they have not thought about the fundamentals of what the properties of Bitcoin allows people to accomplish.
Yeah, I agree. I like the hyper monetization there, foreboding hyper Bitcoinization.
Yes, and so this was actually coined by Conrad Graf, and this is an article by him that is a great kind of forgotten early Bitcoin article. I should probably add it to the mempool.
Because that we all thought, hyperinflation, right? That was the only hyper we knew of.
Yes, yeah. And instead thinking about the idea that you could just rapidly adopt money and actually things get way better, way faster instead of just collapse, and us having to work our way back to a sound economy in some Mad Max world. So continuing on, the purposes of money. But, the whiners protest, Bitcoin can't be used as a unit of account. How can it be a currency when you can't use it to distinguish a profit from a loss? To put this argument in context, let us review the three traditional functions of money. Money is often simultaneously a store of value, medium of exchange, and unit of account. The argument goes that if a good is not useful as a unit of account, then it is not money. However, the only necessary relation between these three functions is that a medium of exchange must also be a store of value. A thing can serve as a store of value without being a medium of exchange or a unit of account, and a thing can be a unit of account without being either of the other two. Conrad Graf has written an article developing this point. That's a tricky one that perhaps we could dive into at a later point. I think there's. I would argue that there's a little bit of confusion that a lot of people have. I think we've talked about this a bit, but with these functions, and I think it all comes down to medium of exchange. But I'm going to continue on. There is no particular reason that Bitcoin's volatility, which makes it less useful as a unit of account, should impede its growth as a currency. It is still excellent as a store of value and a medium of exchange, which are good enough reasons to buy into it. Furthermore, there is nothing stopping a Bitcoin investor from doing business in Bitcoin and using national currencies like the dollar or euro as a unit of account. In the relatively near future, there may come a time when no real unit of account is available because Bitcoin will be growing at a rapid pace even as the other currencies are hyperinflating. The world won't fall apart. People will just have to think a little bit more carefully about their economic decisions during this period, and this will be the ultimate sign of Bitcoin's success. And I would like to point out there's an article we're going to be reading later called Bitcoin is the best unit of account. And it actually starts out with Daniel admitting that he conceded too much here towards the people who make the argument that Bitcoin isn't really a good unit of account. So I'm going to save most of my thoughts on that for later. But I would say that I think one of the basic things here is that it can be less useful as a unit of account if you are trying to deal with certain kinds of short-term business decisions and are dealing with a lot of buying and selling of goods in a short time period, perhaps. But there's also the fact that the real difficulty here has to do with other people recognizing it as a unit of account, such that they want to price things for you, that they are going to price things in Bitcoin for you. But of course, you can still do that for yourself even before others have started doing that. And once again, I think an important point here is that even as this unit of account issue that people might bring up, volatility has empirically not stopped Bitcoin payments from flowing. In fact, I don't know how we would measure this, perhaps through some BTC Pay metrics and some of the other sort of more explicit payment gateway metrics, but the amount of Bitcoin payments happening in terms of people actually buying and selling goods for Bitcoin is so much bigger now than it was back then. And Bitcoin is still, just as volatile, and people still complain about the volatility. And yet a lot of people get a lot of value from being able to use it in their day-to-day trade. There's many things that I find it useful to be able to pay in Lightning for. So empirically, it's just it doesn't help. And so your job as an analyst is not to tell us what you think ought to happen, but explain it. It's like, well, despite the fact that you think it's too volatile for this kind of economic activity, why is it occurring? Why would people do that? Like, I don't think that everyone is just irrational and stupid and just paying with Bitcoin purely for ideological reasons. So what is going on there?
Yeah, there's the wealth effect as well. The price goes up, then people have more to spend.
Yes. So wrapping the article itself up, get ready for a wild ride. Those who worry about Bitcoin's volatility fail to understand what it actually means for Bitcoin. They are not able to think far enough ahead to understand Bitcoin's ultimate destiny. In the short term, what's one decimal point right or left? Bitcoin is unstable at any price, and we should all feel lucky that we managed to get in on it when it still has a price. Now, sit back, quit complaining, have a nice glass of wine, and watch as Bitcoin takes over the world. And we're so early, and we should be happy about, being here so early to enjoy Bitcoin. And, just one thing I want to reiterate is that Bitcoin is anything but volatile in basically everything but the price. It has an incredibly stable supply curve. The mining is incredibly stable in the sense that it works exactly how it's on the tin. Obviously, because it's so profitable, it's a little less than every 10 minutes that we expect blocks, but it all works exactly how you would expect. And so it's literally only the price that has any volatility, and people should take note of that and consider that when they're thinking about how the price is changing. Unless you had something else on that, I had some more questions for you, given your foray into more Bitcoin financial engineering.
No, shoot.
Well, so I think what we've seen since, especially with strategy and so on and so forth, you've announced the founding of your own Bitcoin company called the Bitcoin Bond Company, and a lot of the products being offered in the sort of Bitcoin financial realm are effectively what you were describing, like how to deal with these different risks of Bitcoin price being a little up or a little down. Can you tell us more about what it means for investors? Like what makes volatility so good for investors, and how the financial engineering is able to actually, in sort of a concrete sense, turn that into profit.
Yeah. So basically, the issue is that if we look at it from a subjective, marginal, let's say, appetite for volatility, it really breaks down into there's people who want less volatility and there's people who want more of it. And by that, I mean like the risk return, right? So some people want less risk and are willing to accept a lower return. And others want more risk or want a higher return and are willing to take on more risk to accomplish that. And so, what we've seen over the past, let's say 12 years since this article, or 11 years, is that there's lots of people who say that they'll look at Bitcoin's price chart, and maybe to us it's irrational because we've grown up with it in a sense. But to them, they look at the chart and it makes them queasy. Okay, they can't stomach it, and then they just end up not buying Bitcoin at all or getting any kind of financial exposure on any level, right? Even if it's just a small amount in a Bitcoin wallet. Others want to outperform it, and they turn to things like altcoins, and they're like, okay, well, I'm going to try to outperform it by getting something that's more illiquid and thus has a higher chance of going up in the short term in, what we would pejoratively call a pump and dump. And the problem there is that, it might pump, but it will dump. And that from a monetary economics perspective, the liquidity of it is still going to be drawn away from that altcoin to Bitcoin. So financial engineering is really about sorting out between those two groups. Now, there's the third group of us who are just happy with the what we could call spot Bitcoin risk return. And that's not a problem for us. And so we don't need any financial engineering. We just can hold Bitcoin. For the two other groups, they need to have a risk transfer mechanism that enables the people who are risk averse to essentially take the view that, well, Bitcoin is here to stay. I'm not worried about it long term. It's not going to go to zero, but I don't want to have the volatility, and I want a lower return. And then on the other end, the people who are doing the moon math, it's going to $1 million, so that the former is essentially lending to the latter. And all of this is dollar denominated. So it's all predicated on the idea that there is another currency. It doesn't have to be, in the sense that it could be like pound of beef denominated, right? But in this stage that we're at in hyper-Bitcoinization, that's where I think that it does make sense to have this kind of risk transfer activity happening. And the market certainly has validated that there's appetite for it. And, it's kind of the top of the funnel in my mind. The end of the funnel is converting everybody into being like us and accepting the spot Bitcoin risk return. And I think that, long term, that's what everything will trend towards. But yeah, that's really why the financial engineering actually creates value, because it's not zero sum, in the sense that without the financial engineering, neither of those two demographics would want exposure to Bitcoin. And so we're growing the pie by doing the financial engineering, and that's what creates value.
Right. A lot of people see this and they get upset because it's like, well, it's just some kind of IOU. You're not really getting full Bitcoin. And the thing is, no one's saying that is what it is. Like you said, this is like a first step, because right now, or think when this article was written, especially 2014, there were no real financial markets around Bitcoin. Everything was very binary. You either have Bitcoin or you don't have Bitcoin. Whereas with what you're describing, now there are more gradations that offer different risk return profiles. And that includes the risks of, counterparty risk, and everything that entails, plus, various, corporate risks and, so on and so forth. But you can decide where on that spectrum you actually wish to be. And now you get to be in Bitcoin when you would otherwise just be in the binary of no Bitcoin at all. And
I think that, what I'm describing would be and was impossible if you have this lingering question of, is the government going to ban Bitcoin and seize it all? And so I think that in a low trust jurisdiction or earlier in Bitcoin's life, what I'm describing was completely implausible from just that part of the risk. Now it's like, okay, you could even have both of saying, well, there is this risk that I foresee of 6102 and the government's going to seize it. And so I'm still going to hold some spot Bitcoin, but I'm also super bullish and I'm going to go leverage long Bitcoin. And, before it was like, okay, you go on offshore platform like BitMEX or FT, and there, it collapses, one, because Bitcoin's too volatile, so you get liquidated, or two, because there is no rule of law and there is no kind of
not even as much self-regulation.
Right. Self-regulation, that the whole, marketplace falls apart. You do need to have property rights to have a functioning marketplace. And now, with where we're at in Bitcoin adoption, and you have governments that are adopting Bitcoin, it's a strange paradox, but maybe we'll discuss in the allure and appeal of Bitcoin, a future article that gets into that yes, governments will adopt it, the financial system will adopt it. And interestingly, if we look at the history of Bitcoin volatility, it has been decreasing. And I think that kind of goes contrary to part of this article that was basically saying that Bitcoin's always going to be as volatile. The volatility is decreasing. I think that it is the size of the markets as it becomes more liquid, the volatility is decreasing. But we also can't take it for granted that will continue in the sense that you could have an increase in volatility. The volatility is spiky, right? Volatility itself is volatile. If we think about the derivative of, motion, acceleration, and that the other part of it too is like the Parker Lewis gradually then suddenly, right? So we could see an inflection point of adoption where in dollar terms, it is very volatile again. But there are, what I just described of the risk transfer, that actually also itself dampens the volatility of the spot Bitcoin price. Because now people who are marginal in their propensity to hold Bitcoin, they are less likely to trade in and out. And because now they are solidly along that gradation of risk return, that they're at the point where they can stomach it because of the product that they're in. So it's a completely different trust model than holding your cold storage Bitcoin with your node. And so that's, I think, probably hard for us Bitcoiners to view it charitably. But I also think that if you look outside of Bitcoin, where have the property rights violations happened? I really think it's concentrated in the monetary system itself, through the currency debasement. If you look outside of that, the property rights in the financial system are actually pretty solid.
Yeah. There's not a lot of busting open people's 401ks to get money for the government
so far, right?
Yeah.
In other countries, absolutely, that has occurred, and so it's also context specific. Do you believe in American exceptionalism and the institutions that our founding fathers gave us, which I understand from an international perspective might not apply?
Right. I guess there's some interesting stuff there because, yes, the volatility has gone down, but as you were saying, inflection points could happen, and it could almost happen for any reason, in the sense that it's kind of like a great awakening type thing, right? Where if everyone just woke up tomorrow and for whatever reason they managed to understand Bitcoin, something happened that just allowed people to quickly understand, they would all be rushing to buy Bitcoin and the price could go up. I think regardless of, the volatility, I would imagine that these different, financial instruments are also helping in speculation. So one of the benefits of speculation in an economy is assisting with price discovery and basically bringing price discovery faster. So in the case of where we are now, maybe volatility is less, and having this on both sides allows Bitcoin to just smoothly be eating up more of the economy. I do wonder, in the case of a more rapid growth, if this would also have the effect of making it even more rapid.
Yes, because ultimately for these financial instruments, if done correctly, they are increasing demand for spot Bitcoin. So it's, done incorrectly, then they get wrecked because they don't have the underlying asset that they're tranching up. But that's a little bit of a nuance there.
Yeah. There's also, I don't want to really call it a paradox because I don't think it is. It's only a paradox to maybe like a Keynesian or something, but or people who are really fixated on the volatility issue. But as far as, if these things are actually helping smooth out Bitcoin in a sense, it's actually, it's helping reduce the volatility, which actually, it helps Bitcoin get to where people can do more sort of day-to-day trade, there's certainly times where it's like, oh, I wouldn't want to pay Bitcoin on that because if the price shoots up tomorrow, like I'll feel silly. So, or vice versa. And so that is a real thing that goes through people's minds. But the more that you have these, then you do have these periods of time where people might feel more comfortable engaging in those trades because of this. So the people who don't like the volatility, they should have been doing this the whole time. They should have said, well, how can we reduce volatility? It's like, okay, well, how can we get the government to be less hostile to Bitcoin so that there's less regime uncertainty that Bitcoiners have to face. And given more regime certainty, what kind of businesses can be built to actually help smooth out that process and so on and so forth. So they should have actually been helping. And then I would say from the point of view of the people who are more purists in the sense of, wanting to be the sovereign Bitcoiner, hold their own keys, run their own node, all of the good things that people really should be working their way towards, but also getting into that point of talking about, circular economies and paying for things in Bitcoin and all of that. You should then also, you shouldn't view this as a negative for Bitcoin because, like you said, the pie is only getting bigger, and now you have more people engaged with Bitcoin than otherwise. But also, their specific type of activity is opening up new ways for your trade to be possible because you're trying to buy and sell things with Bitcoin. So when those people are coming in and making Bitcoin more useful, not just because the price going up, but also helping smooth out some of the volatility that might arise, it makes it even easier for you to do that. And so I think a lot of people come into Bitcoin from a lot of different reasons. And, you said, it can be hard to be charitable. I think that really is something that Bitcoiners should strive for is thinking charitably about the actions of different actors within the Bitcoin economy so that we can kind of do, say a sort of defend the undefendable type thing. We can look at an activity and, that's not to say literally all activity on Bitcoin is good and just and so on and so forth, but we can look at people who are introducing financial instruments and actually think through the logic of it, think through the economics and see, oh, here's how it's actually benefiting the economy as a whole. And that person is choosing a different risk profile than I would personally want, but his actions still have a sort of gratuitous benefit on my use of Bitcoin and vice versa. The people who are, I understand, for instance, the frustration with people who come in and just talk about number go up. Once they sometimes cross the line and start kind of shaming people who actually really do care about holding your own keys, because the reason that those people have a financial instrument that they can go in and invest in and see number go up is ultimately dependent on the fact that there are a large group of decentralized people who hold their own keys and run their own node to make sure that Bitcoin actually upholds the monetary properties that they believe. And so I think everyone can benefit from trying to think charitably about the other actors and think about what good comes out of it and be open-minded to people having different risk profiles, going both ways.
Yeah, and the horrible metaphor I use, which is full of problems, but I think illustrates the point, is the difference between the Apple shareholders and the iPhone users, right? Where you might say, oh, instead of buying an iPhone, you should buy shares of Apple. And then they might say, well, if everyone did that, then the shares of Apple would be worthless, and vice versa.
Yeah, it's a pretty awful metaphor, but I also see how it works. So, well, thank you for explaining more of the financial stuff. I think it's important. Like Bitcoin has less volatility, and yet it still has a lot of volatility, and it might even have more in the future. But everyone who sees Bitcoin's potential also has the ability to capitalize off that, and they should see it as a good thing that is bringing value to their preferred medium of exchange.
And the last point I want to leave with is that historically there have been periods where Bitcoin's price is pretty stable. And we'll joke on social media that Bitcoin is now the stable coin because it just goes sideways. And I actually think that during those periods, you do attract people who were not interested in it when it was being volatile, upwards or downwards, 6 months before. And then as they start accumulating, they cause volatility. And so it's the reflexivity of it as well.
Yes, and it also is a great time to be focusing on future potential volatility and how to overcome it. So things like, how that might affect transaction fees. So getting lightning channels ready ahead of time so that you can withstand that kind of volatility. It's always a good time to be planning for the future. Whether you're down, whether you're sideways, whether you're up, always having that future orientation is so incredibly important.
That's a great point to leave on there.
All right. Well, thank you for listening to The Reorg. This podcast is brought to you by the Satoshi Nakamoto Institute, dedicated to advancing and preserving Bitcoin knowledge. Our mission is to deepen understanding and appreciation of Bitcoin, not just for today, but for generations to come, by creating enduring educational resources and generational knowledge for generational wealth. If you enjoyed the show, please support our work by sharing links, deepening your own Bitcoin knowledge by exploring studying the SNI archives, and contributing sats. As a 501c3 nonprofit, we rely entirely on supporters like you. Whether you can give a few Satoshis or a few thousand Bitcoins, your contributions enable us to continue educating current and future Bitcoiners worldwide.